Hey everyone, Ivan here. Today we're going into something truly fundamental, financial literacy principles based on Austrian economics that can help everyday investors navigate today's complex financial landscape. If you've been following my channel, you know I'm committed to providing honest, practical information without the hype. Today's topic is especially important because understanding these fundamental economic principles can completely transform your approach to investing and financial planning. The Austrian School of Economics offers powerful insights that have predicted major economic events when mainstream approaches failed. From explaining why inflation happens to offering strategies for preserving wealth, these concepts are incredibly valuable for any investors. Let's explore how Austrian economic principles can guide your financial decisions and help you achieve true financial freedom in an increasingly uncertain world. In the previous video, I talked about inflation in depth. So right now, we will see at the heart of Austrian economics that is a fundamental understanding of money and inflation that differs significantly from mainstream economic theories. According to Ludwig von Mises, one of the founding fathers of the Austrian school, inflation is not simple rising prices, but specifically an increase in the quantity of money that is not offset by a corresponding increase in the need for money. This definition contrasts with popular views that treat inflation as merely a symptom rather than identifying its root cause. Why does this matter for everyday investors? Because understanding the true nature of inflation helps you, first, recognize that inflation is a monetary phenomenon, not something that just happens. Second, understand why your purchasing power decreases over time. Third, make better decisions about protecting your wealth. When central banks create new money, this doesn't immediately lead to price increase across all sectors simultaneously. Instead, the newly created money enters the economy through specific channels, often financial markets and real estate first, before gradually affecting consumer goods. This is known as the Cantillon effect. Those closest to the source of new money benefit first, while those furthest away, typically wage earners and those on fixed incomes, bear the brunt or inflation after prices have already risen. For investors, inflation acts as a hidden tax that erodes the value of cash savings while benefits asset holders and those with debt. Understanding this dynamic is crucial for developing strategies to preserve and grow your wealth in an inflationary environment. The Austrian business cycle theory offers powerful insights into why economies experience booms and busts, knowledge that can help you avoid making costly investment mistakes during market euphoria. According to Austrian economics like Friedrich Hayek, artificial manipulations of interest rates by central banks distorts market signals, leading to periods of unsustainable growth followed by inevitable corrections. The theory explains how artificially low interest rates lead to excessive borrowing and malinvestments that eventually require painful corrections. Here's why this typically plays out. First, central banks lower interest rates below natural market levels. Second, business and investors are incentivized to take in more risks and debt. Third, capital flows into projects that appear profitable only because of cheap money. Fourth, resources are misallocated into areas that won't be sustainable long term. And fifth, eventually these malinvestments must be liquidated, causing recessions. We've been seeing this pattern repeat throughout history, from the 1920s stock market boom to the 2008 housing crisis. In each case, artificially cheap credit fueled unsustainable booms that an inevitable collapse. For investors, understanding these cycles provides a tremendous advantage. You can first recognize when markets are becoming overheated due to artificial stimulus. Second, avoiding chasing returns in sectors experiencing unsustainable growth. Third, position yourself defensively before corrections occur. Fourth, take advantage of opportunities during downturns when quality assets are undervalued. By recognizing these warning signs of malinvestment, you can make counter-cyclical investment decisions rather than following the crowd into bubbles. A cornerstone of Austrian economics is the concept of sound money, currency that maintains its purchasing power over time and can be manipulated or devalued by central authorities. Historically, gold served this purpose for thousands of years. A common example is that once an ounce of gold could buy a fine men's suit in ancient Rome during the Renaissance, and still can today. Meanwhile, fiat currencies like the dollar have lost over 96% their purchasing power in just the last century. According to economist Murray Rothbard, sound money is essential to a free society because it limits government's ability to finance itself through inflation, forcing it to rely on direct taxation that citizens can see and evaluate. For investors seeking to preserve wealth, understanding the spectrum of monetary hardness is crucial. Hard assets, limited supply, gold, silver, Bitcoin, certain collectibles, other productive assets, business, equities, productive real estate, soft assets, easily created, fiat currency, government bonds. In a sound money system, savings are rewarded rather than punished. Your purchasing power increases over time as productivity improvements lead to falling prices for goods and services. This contrasts sharply with today's systems where cash savings steadily lose value. Everyday investors can apply sound money principles by first maintaining some portion of savings in hard assets as insurance against currency devaluation. Second, focusing on businesses with a strong balance sheets and pricing power. Third, being cautious with long-term fixed income investments that don't account for inflation. And fourth, understanding the difference between nominal and real returns. The key insight here is that measuring wealth in currency units can be misleading. True wealth is measuring what your assets can purchase, not their numerical value. One of the most powerful yet underappreciated insights from Austrian economics concerns the vital role of saving in creating prosperity. Contrary to popular economics theories that emphasize consumption as the driver of growth, Austrian economics understood that real economic progress comes from deferring consumption saving to build capital goods that increase future productivity. Think about this way. A fisherman who consumes all his daily catch will never improve his situation, but if he saves some fish to sustain himself while building better equipment, he can dramatically increase his future production. The same principle applies throughout the economy. This relates to the Austrian concept of time preference, our natural tendency to prefer goods in the present rather than the future. Lower time preference, greater patience, leads to more saving, investment, and ultimately greater prosperity. For individual investors, this has several important implications. First, true wealth comes from producing more than you consume and investing the difference. Second, building capital through consistent saving is the foundation of financial independence. Third, investment should be evaluated based on their contribution to future productivity. And fourth, artificially low interest rate discourage saving and encourage debt-filled consumption. The most successful investors understand that building wealth is primarily about consistently saving and allowing compound growth to work over time, not about finding get-rich-quick shortcuts or timing market movements. By focusing on building productive capital rather than maximizing consumption, you align your personal finances with the economical principles that create sustainable prosperity. The final key insight from Austrian economics concerns the critical role of prices, profit loss signals, and entrepreneurship in coordinating economic activity. Friedrich Hayek emphasized that the price system transmits scattered information that no central planner could ever process. When prices are allowed to move freely, they communicate critical information about relative scarcity and consumer preferences, guiding resources to their most valuable uses. Entrepreneurs play a vital role in this process by first identifying unmet needs in the market, second, taking calculated risks to serve those needs, third, learning from profit and loss signals, fourth, adjusting course based on market feedback. This understanding highlights why centrally planned economies are inevitable fail. No central authority can possess the distributed knowledge needed to coordinate a complex economy. Markets, with all their imperfections, outperform planning because they harness the dispersed knowledge of millions of participants. For investors, these principles suggest, first, diversification is valuable because no one can perfectly predict the future. Second, markets generally allocate capital more efficiently than government planners. Third, businesses that respond effectively to market signals tend to outperform over time. And fourth, sustainability profits can come from creating genuine value, not from government privileges. Understanding these principles helps you focus on investments that create real value rather than those that rely on artificial supports or speculation. Now, let's translate these Austrian economics principles into practical strategies for everyday investors. First, maintain sound money reserves. Hold some portion of savings in inflation-resistant assets. Consider traditional stores of value like precious metals. Understand the risks and potential benefits of alternatives like Bitcoin. Recognize that cash is guaranteed to lose purchasing power over time. Second, focus on productive assets. Invest in businesses that create genuine value for customers. Look for companies with pricing power and strong balance sheets. Own productive real estate that generates income. Understand what makes a business truly productive versus dependent on artificial support. Third, avoid malinvestment traps. Be skeptical of bonds fueled primarily by cheap credit. Look beyond nominal returns to understand real, inflation-adjusted performance. Recognize when entire sectors are being artificially propped up. Position defensively before obvious bubbles pop. Prioritize consistent saving over consumption. Reinvest returns to harness the power of compounding. Focus on building productive assets rather than maximizing current income. Think in terms of decades, not quarters of years. Fifth, develop an entrepreneurial mindset. Constantly look for value creation opportunities in the market. Learn from mistakes and adapt your strategy based on results. Focus on solving real problems rather than exploiting in regulatory loopholes. Understand that genuine wealth comes from serving others. A balanced approach might include productive businesses, stock, or direct ownership, income-producing real estate, hard assets as inflation protection, some cash for opportunities and emergencies, continuous investment in personal skills and knowledge. Remember that successful investment is about steady progress over time, not dramatic overnight gains. By applying these Austrian principles consistently, you position yourself for sustainable financial success regardless of economic conditions. The Austrian School of Economics offers powerful insights that can transform your approach to investing and wealth building. By understanding the true nature of money, business cycles, savings, and markets, you gain a tremendous advantage in navigating today's complex financial landscape. While these ideas may differ from conventional financial wisdom, they've proven remarkably accurate in explaining economic phenomena and helping investors preserve wealth through turbulent times. I encourage you to explore these concepts further through resources like Murray Rothbard's Writings on Money and Frederick August Hyde, Insights of Knowledge in Markets. These foundational works provide a deeper understanding of the economic principles we've discussed today. What aspects of Austrian economics do you find most valuable for your personal finances? Let me know in the comments, and don't forget to subscribe if you like this content that cuts through the noise and focuses on enduring principles rather than fleeting trends. Remember, true financial freedom comes not from following the crowd, but from understanding fundamental economic principles and applying them consistently over time with a lot of patience. Of course, by grounding your investment in strategy in sound economics, you position yourself for lasting success regardless of market conditions. This is Ivan, helping you build real wealth through timeless principles. Thanks for watching. I see you in the other video.